Very good morning. Welcome to today's market snapshot. You're joined by Nobert Kiiza, and I'm very happy to be here with you today for today's market snapshot. Today is a very eventful day. We have quite a bit of data that is coming out. As of this morning, we've seen data coming out for the pound, which is the GDP data, which again was not that good. The United Kingdom is currently facing an issue of okay, just a moment. Sorry, my apologies for that. Okay, the United Kingdom, as well as also the Eurozone, is facing a challenge of stagflation. As you are well aware, we've been having consistently high inflation in this in the Eurozone as well as also in the UK, and that is providing a lot of downside pressure to the Great Britain pound, as well as also to the Eurozone euro. This data, which came out at 9 p.m., indicated to us that we had negative GDP month-on-month reading, as well as also a very strong contraction on GDP for the UK, which came in at 0.0%. The policymakers in the UK, as well as also in the Eurozone, are facing challenges of how to go about the issue of inflation, and it's putting a lot of downside pressure on the currencies. I think you've been seeing how the pound has been faring over the past few weeks. It's actually been facing a lot of downside. Same thing for the euro. And now that their issue had actually been inflation, the issue now that's on their table right now is now contraction that we are seeing. So we should see a lot of downside coming for the pound from that. The Bank of England Governor Bailey had also indicated that they also want to come to the end of their rate hike cycle. The other thing is with them coming to the end of the rate hike cycle, that the reason why they want to do that is they want to avoid a situation where the financial conditions become too tight, and which again make it hard for them to get the economy back on its feet. So there's actually a lot to monitor now, and this should provide a lot of catalysts for trading in the markets. So as we continue later, we have the US CPI, which is the main focus for today. The US CPI is coming out at 3:30, and we are going to get 4 sets of data. The data which we are getting currently, the forecasts which we are having are showing that the CPI is forecasted to move in opposite directions. I want to start with the core CPI. So the core CPI has been declining by about 0.1%, steadily declining, and currently it stands at about 4.7%. And when we had high inflation in the US last year, this inflation was actually back in 2022 when oil prices were high. But keep in mind that also the core CPI was actually equally high, and right now it's standing at about 4.7%. However, analysts and economists are forecasting that there's going to be a decline in the core CPI reading from 4.7% to 4.3%. However, we are all aware that we have been having high oil prices, and keep in mind that oil prices also in the US at a 10-month high. So that 10-month high was achieved sometime in August, and that is also going to reflect with the CPI that we're getting today. So we can expect the CPI to come in higher, and that's the reason why I want us to go and see the forecast for the different banks. The banks are targeting a CPI reading. Their median target is about a CPI reading of about 3.6%. However, what traders need to understand today is that since we have the forecast for a potential decline in core CPI year over year from 4.7% to 4.3%, and then we also have a CPI year over year increase from 3.2 to 3.6, what is potentially going to be the mover for us today, and what should be our major focus is we should be focusing on what the reading comes out for the CPI year over year. If we get a reading of CPI year over year above 3.2% and potentially even above this forecast of 3.6%, we should see some strong sell-off for that dollar. And that should also be intensified if on the core CPI, we also manage to fail to decline more than 0.1%. If we get a very slight decline of 0.1%, if we get a reading that is in line with the previous of 4.7%, then we can expect there to be some very strong selling for the rather very strong buying for the dollar. Now, the dollar has also been under immense upside, as you see, when we check on Trading View, when we go to the DXY, we have been seeing the DXY steadily rising, and most of the current medium-term targets for the dollar are for it to move higher back to its October 22 highs, which are somewhere around here. And keep in mind, much as we're also focusing on the CPI, next week, we have data coming out. We have the Fed conference, and that Fed conference is actually going to keep traders on their toes, since the Fed will be monitoring to see what happens. So right now you can see DXY has had a bit of a rally, and it's right now on a pause, but I'm expecting that we should have a DXY taking out 105.8, which could then provide it very strong upside today. And same thing also for the USD pairs. We should see the USD pairs having very strong movement on an increasing CPI. Now, I also want to focus on the CPI month-over-month forecast, which you're seeing is potentially likely to increase from 0.2% to 0.6%. So as you can see here, this forecasted increase is not a simple one. They are forecasting an increase of about 0.4%, which is actually quite high. And these forecasts, again, were already, I expected them. And the reason for that was majorly because oil prices in the US have been steadily rising. So for me, they are not new to me. So before we go to the charts, I want us to quickly go and see what the banks are targeting on CPI. So I'm going to start with TDS. So TDS is saying we expect the report to provide additional evidence that the core segment has taken a step down in terms of sequential price gains. And again, the core CPI is essentially what is providing us a steady decline. But the headline, which prices in oil prices, is showing us that we're going to see a higher increment. So when we go to RBS, quickly, RBS is saying we expect headline CPI to tick to 3.6% year over year in August, up from 3.2% in July. This increase is almost entirely explained by higher global energy prices. Yes, this again is expected because global energy prices have been rising, and that is also going to reflect to that CPI. So we can expect the CPI to tick higher, and we should see a very strong number, possibly above 3.6%. What this means for traders is, again, the bias going to CPI, definitely we're going to have a USD bullish bias supported by a higher forecast for CPI. NBF is saying that the energy component is likely to have had a sizable positive impact on the headline index, given the sharp increase in gasoline prices. Again, this, of course, is also expected. So if we cross over to Citibank is saying we expect a stronger increase in core inflation in August after two consecutive 0.16 month-over-month increases, with a core CPI rising of 0.3% month-over-month. Meanwhile, the headline CPI should rise a strong 0.6%, the strongest increase since June 2022. So now, right now we are in very, very tricky times, and again, very good times for traders, because the market is presenting a lot of trading opportunities, especially for those of you that have been trading oil. You must have seen that we are seeing some very strong upside momentum on oil, which is also likely to continue, and which should present us some good opportunities for us to look for entries. So ING is also looking at a potential increase for CPI, much as the others are looking at 3.6% target. For them, they're focusing on a target of 3.5%, and we should see CPI steadily rising. Yeah. So Wells Fargo, which is also another bank in the US, we forecast core CPI gain 0.18%, equating to a 4.3% year-over-year rate. If realized, the Fed could achieve its elusive 2% target on a 3-month annualized basis within core, commodities, and shelter. So CIBC again is also looking at an increase, as you see here, to 3.5%. Deutsche Bank is also looking for an increase from 3.6 to 3.6%. So generally, we can say the medium target for the banks that we get an increase for CPI. So we should see some good movement from there. So the other news that we have coming out today is crude oil inventories. So crude oil inventories in the US have been steadily decreasing, and right now the issue that the US is grappling with is that their petroleum reserve seems to also be at the lowest point since 1985, and that is also providing a lot of potential for buy opportunities on gold rather on oil, and we should see that continue as we go again. So without wasting time, let's quickly cross over to the charts and see what the charts are presenting us. So we are going to start with GBP USD. You should see the charts in a moment. If you have any questions, please write them in the comment section. I will be able to respond to them soon as I'm through with the snapshot. Please write every single question you have in the comment section, and we shall handle it as we go along. So the reason why I'm showing us GBP USD on the H4 is because I needed us to focus on these different supply zones which I have marked here. So right now, GBP USD is up around 6% from its March lows of $1.22, and from March to when it achieved its high at $1.30, GBP USD was up around 11%. So currently, and again, the reason why I expect that GBP USD should have more downside from here is because the most of the economic data we are getting from the UK has been pointing to a very strong contraction in the economy. The other thing is that the Bank of England does not have any hopes of potentially hiking their rates when they meet next week but one, and that should provide the GBP USD a lot of downside momentum, potentially achieving this area where we are seeing this zone here. So again, the other thing is GBP USD has also consistently provided a lot of lower lows, as you can see with this asymmetrical triangle here. We have been seeing a lot of rejection candles and liquidity grabs to the downside, and even now recently we had a break below this asymmetrical triangle here, which has continued to sustain it down here. So fundamentally, there's a lot of support for a bearish pound, and I'm expecting even today, if we get a CPI reading above 3.6% on the year over year and a very slight decline on the core CPI reading, we should see a very strong sharp sell for the pound, which could allow it to achieve as much as it should be able to achieve between 100 pips to around 200 pips from that movement. And again, most of the traders are cutting their short-term long positions on the pound simply because of weakening data. Crossing over to the Nasdaq. So the Nasdaq, again, what has been supporting the Nasdaq in this current zone has been a sharp movement in Tesla. Tesla was upgraded recently by Morgan Stanley from an equal weight to an overweight, and Tesla was up about 10% yesterday, and it was up about 10%, sorry, on Monday, and that has provided very, very strong momentum for Tesla, rather for Nasdaq. But I'm expecting if we get any increment on CPI today, we should see Nasdaq break below this asymmetrical triangle and take out this zone here, and potentially now aim for the low which it achieved before NVIDIA earnings. That was about almost, I would say, about a month ago. which was around here where we had 14,600. And I'm expecting that if we break below this asymmetrical triangle, we should see a break below this area, which should then have the selling intensity move there. Now, if the core CPI does not, if the core CPI declines strongly to about 0.3 or 0.4%, then we are potentially going to see Nasdaq breaking above this asymmetrical triangle and potentially now aiming for these zones here. But if you're keen, you might have noticed that Nasdaq has had a lot of grabs. It has not managed to sustain its buy momentum. Its buy momentum has been weakening and weakening at every single time. And you can see that even right now, it's struggling and ranging as the markets wait for the CPI reading, which we're going to get later today. So we should see a very strong sell within the US session, potentially taking us to this level. However, if the CPI reading does not impress to the upside, then we should see some buying that will come in, or we should see some ranging, but within this triangle here. So Dow has been providing quite very good setup. Last week, of course, on Dow, we had a fake out, rather towards the end of August, we had a very nice fake out, which allowed Dow to buy. But you can see that since Dow had its buy from this fake out zone here, okay, it has been printing lower lows, rather lower highs, and which have consistently now resulted into a bearish flag, which you can see here. So this bearish flag here, as you can see, Dow has been respecting it quite nicely, and it broke below the bearish flag just a bit sometime yesterday. We had a very nice liquidity grab to the downside. And again, right now here, the reason why we had this spike lower was because there wasn't enough upside momentum or demand to take it to the next levels. But you can see that the reason why we are having this weakening decline is also indicative of these lower lows, these lower highs you're seeing there. So I'm expecting that to break below this bearish flag and potentially start getting closer and closer to this level here where it had a fake out. And if we achieve this level here, then Dow is going to be looking at opening itself up to levels which we saw when we had the Q2 earnings sometime last month. So as of now, we should be looking for potentially some trades here that should aim Dow, taking it back to this zone here. And on the flip side, if we do not get a very impressive CPI, and again, if core CPI, the core CPI year-over-year reading especially, if it increases, rather if it declines by between 0.2 to 0.5%, we are going to see Dow potentially taking out this level and maybe starting to aim to potentially reach some of these levels which it achieved sometime earlier 2 weeks ago. So crossing over to gold. So again, gold presented to us a very nice bullish flag, coupled also with an ascending wedge. That ascending wedge was achieved around the 31st of August. The key level for gold right now should be this level of 1903, where we had a very nice liquidity grab. If this grab appears again, then gold should be supported to the upside. But for now, I'm expecting very subdued upside for gold, and again a higher CPI reading on the year-over-year, the headline reading, as well as also the core reading, should present us a bon opportunity to short gold back to this level here where it was before we had which was after Jackson Hole. What has been supporting gold has majorly been a bit of a potential seasonality for a jump in the VIX. So the VIX is the fear index, and traders have been anticipating a sharp movement for the VIX. So if this continues, then gold most probably is going to have very strong momentum to the upside. But for now, I'm expecting gold to respect this bearish flag, and we could have that selling continue possibly all the way back to this zone here. So as we go into CPI, if we get a very strong CPI reading this afternoon, ladies and gentlemen, then we are going to see gold potentially take out this level here. It could easily take out this level very easily, simply because this could be a momentum move, which could allow gold to test further lows. However, on the flip side, if gold does not take out this zone, and again, if the CPI does not present any potential downside for gold, the next level for it to achieve is going to be this level here, where we had a liquidity grab here. And the reason for that was because there was very little demand at this zone. But I'm expecting that for gold to have any buying intensity, we need to achieve this level right here. So for now, we should see gold potentially moving lower as we go along, as we wait for CPI. So I also want to check out Euro USD. Now, Euro USD has been presenting, Euro USD has had several bearish flags. There are many of them, and they have been appearing from as far as 9th of August all the way up to September. Currently, the fundamentals do not support a buy on the euro, simply because the central bank, which is the ECB, has been pointing towards potential rate cuts, rather rate hikes, and that is presenting further downside for the euro, closer to parity, which is above one here. The other thing also is keep in mind that rising gas prices, global gas prices, are not good for the Eurozone, because it usually spikes inflation and makes the oil that is available in that Eurozone to increase, rather the oil prices for that Eurozone to increase. So that is presenting downside for the euro. So the euro has been selling consecutively every single day that the euro has been opening in the market. It has been having selling intensity. And right now we have a very nice bearish flag that is forming up on the euro. As you can see, there's a lot of downside momentum for the euro and a lot of supply, which should take it back to this zone here, which is around from here. That's around 200 pips, and we should be able to achieve that today. If we don't achieve it today, then we should see that level being achieved potentially sometime on Friday. So this zone here is currently where the euro is likely to go to. And the next cycle for buying for the euro should not come in until October. And again, most of the central bankers have been targeting to see how the incoming data appears. So for now, we should see some potential selling for the euro with CPI. If the CPI core number, especially, which is our focus, the headline number should not be the focus. The focus is the core number. If the core number increases, okay, let me just quickly go to that number so that we are aware of it. The core number is the one which is going to stop a bullish dollar today. If we see the core number declining to this forecast of 4.3%, then every single risk-on asset, like the euro, like the pound dollar, like the NASDAQ, the Dow, the DAX, all of those different assets are going to present a potential reversal to the upside. So our focus is actually this core number here. If the core number declines in line also with the anticipated increase on the year over year, which again is going to happen, there's going to be an increase for this CPI year over year simply because of rising gasoline prices. If we get this increase here, rather the decline here, and then if we get an increase here, then the euro most probably is going to range. The most it will do will be anywhere below 100 pips. It won't do that much. But if we get a very strong CPI reading, we are going to go back selling into this zone here, which we saw sometime. We saw this zone sometime in May. Okay, so this is very easy for the euro to achieve. Now, I want to quickly go to the DAX. So the DAX again has been having a lot of grabs, and most of the day traders have been seeing a lot of ranging on DAX. The reason for that is because the DAX he's been facing a lot of fundamental news. Every single day, we have been seeing a lot of momentum weakening and choppiness on the DAX. However, the movement for it has been sustained within this zone, as you can see. But on the longer term, and again, even on the medium term, I'm looking at the DAX potentially reaching this zone. The play today for the DAX could be how it reacts within this area here. We should not see that much reaction for the DAX from the CPI, because the CPI usually affects the dollar currencies as well as also the dollar assets. So we should see how DAX moves. If case we get a strong higher reading, then the DAX definitely is going to take out this ascending trend line here, and then send it scattering all the way down here. If we get, however, a higher reading, rather a lower reading for core CPI year over year, US inflation, then we are going to see the DAX rising back to this area here where we had the last liquidity grab. So as of now, there's been a lot of sustained upside for it, and the reason why we're having a lot of liquidity grabs to the upside for that for the DAX is simply because it's right now in a bullish year. And usually what happens is when these assets are in bullish cycles, every single time there is news and there's bullish news, it responds quickly to the bullish news. But when there is any bearish news, it doesn't respond that fast. Yeah, so we should see what happens there with the DAX. Now, I quickly want to go also to Euro US. Yeah, okay, I'm done with Euro USD. I just want to see oil here quickly. So oil again, oil had quite a number of crossovers last week. And as you can see, the crossovers have been presenting a potential buy for oil. And even now, the momentum for oil to the upside is still sustained. We've been potentially seeing how oil has been moving within this area here. And you can see that ever since we had this crossover, we had a crossover over the 50-day and the 200-day moving averages. Currently, the 50-day moving average crossed on the 28th of August, and it has remained above the 200-day moving average. And every single time we are seeing price action or candlesticks touching this 50-day moving average, are looking for buy trades. So right now, oil is in a very strong upside momentum, and this should continue potentially all the way back to levels that we didn't see until that was last year, I think in 2022, October 2022. So for now, we should see some strong upside momentum potentially coming in for oil, which could continue to take it to areas above $90 and even possibly close to towards $100. So if we go to the daily, we should see there's something that I'm trying to see here. Just a moment. Yes. So on the weekly, oil is aiming to take out this level, which we saw in November 2022, which is about $91. Something that I also need to mention, which is also very important, especially for those of you that trade the Canadian dollar. Keep in mind that the Canadian dollar is replicating oil on many fronts, especially where it has the lower yielding currencies. We are seeing a lot of momentum for it there. So for now, you can see that oil is aiming to take out this level here, which we saw in November 2022. And the upside momentum and demand for oil is very strong right now in the market, potentially looking at it, taking out this level and even aiming to get into this territory here. But any break above this level here will depend on how market forces for oil take place. We also should see how the different data for the crude oil inventories come out for oil. So for now, that's what I have to say for oil. Then we can finalize by going through GPP, JPY, and then we can see what is in the comment section. If you have any questions whatsoever, please make sure you indicate them in the comment section so that I can be able to handle them after the snapshot. So the JPY pairs had achieved their highs currently for the year, and we are seeing a bit of choppiness to the downside. Very many lower highs appearing on the different currency pairs for the JPYs, where we have the base, where we have JPY as the quote currency. All those different currency pairs are printing for us lower movements, and the reason for that is because traders are trying to be careful of any intervention by the Bank of Japan. If the Bank of Japan intervenes in the forex market, which will be anytime, then we should see very strong buying for the JPY assets, which will then send GPP JPY potentially could go back to this zone, okay, which was our last supply zone, and any break below it should potentially send it back below here. Okay, so for now, I'm expecting GPP JPY to remain ranging here. And again, even right now, I'm seeing a bit of a bearish flag forming here. And we should see how it reacts within this zone. If we get any break below this zone here, then we should see it potentially selling all the way back below here and potentially breaking below this zone. So for now, GPJPY is ranging, but it's putting itself within this, within price action is contained within this area here. So we should see a break below here, potentially taking us closer to these levels that we saw sometime in August, earlier August. So let me just quickly now go to let me just quickly now go to the comment section so that we see what questions we have there. Yes, so Jimmy, hey Jimmy, hey Mary, hey Lucy, hey Jimmy again. How do you know if Fed is hawkish? Okay, so any hawkishness in Fed, okay, should be seen by a rising dollar, simply because a rising dollar means that the Fed is potentially looking at hiking rates. And hiking rates again would mean that the dollar assets usually gain value. But for traders, what we are seeing is right now the Fed is actually potentially looking at holding rates in their next meeting. The next meeting that the Fed is going to have is next week. Now, coming to that point also, and what is very crucial for traders is the CPI play, or the CPI trades or playbook for CPI is going to be separate from the one of next week. The one for next week is focusing on the Fed conference. So the Fed has indicated that if they potentially look at any rate hikes, that is going to depend on incoming data. So the incoming data we're talking about is the GDP data which we got for the US, which increased to about 2.1% from 2%. Which was a moderate increase and which is again okay for the Fed. The other one is the inflation data which we are getting today. If we get slowing inflation on the core, okay, because the focus for the Fed is on the core CPI. The one for headline is beyond them. The Federal Reserve in the US cannot control what is happening with global prices for oil. Okay, all they can do is to just say that we are just going to continue monitoring how the oil prices develop and see how that is going to translate with any impact on our policy. But for them, their major focus is on the core, because that is the one that is the true inflation that we're going to see, the core inflation. The one for headline, which takes into account energy prices, we want the Fed majorly won't focus on that one because they can't control the oil prices. It's beyond them. Now, what I have here before you, I don't know if you guys are seeing this. I think I need to share it. Let me see. Okay. Yes, I think you should be able to see that in a bit. Yeah, so this one are the target probabilities for next week's meeting, the Fed's meeting. Currently, the Fed is anticipated to keep their rates on hold, and we are seeing a 93% chance of them holding the rates. Now, what that means is right now the dollar would potentially trade using CPI, but the play for the dollar next week is going to change. It's going to now focus on this Fed. So if the Fed right now, as we go into the meeting next week, is going to look at a potential hold of the rates. However, when we go to November, the November meetings are looking at a rate hike of 38% to 5.75%. Okay. So now, right now, we can say that the Fed is dovish. Okay. So to answer your question, Njoroge, you're asking about the Fed. The Fed right now, they have actually a dovish stance. Okay. That is why we are seeing that kind of reaction in the markets. Okay. So the other question which I'm seeing here, Joseph, you're saying, okay, before I go to Joseph, Paul, you're saying greetings, sir. Okay, hi, Paul. I hope you're doing great. Jimmy, you're saying, for instance, last CPI, we expected the dollar to be weak, but instead it was strong. Now, the reason why we had a strong dollar last CPI was because the CPI, the headline CPI increased from 3% to 3.2%. And that's why we had some choppiness. Now, I can also try to advise you all, please also take into account that there are two sets of data. Okay, there are two sets of data. We have the core reading, and then we have the headline reading. Okay, so the core reading does not take into account the energy prices, the food and utilities. Now, this core reading is likely to what? To increase. Okay, this core reading here. You're going to see it in a bit, those of you that are live. Then the headline reading, which is this one here, is anticipated to also increase. Okay. Now, if we get a decline here on the core reading and we get an increase on the CPI over here, expect some choppiness. The choppiness will be there because the traders will be indecisive about how to go about that CPI. Okay. But as we go into CPI, the CPI trade right now is a choppy one. It's a mixed one because we are the core reading is expected to decrease, and then the CPI headline is expected to increase. So because of that, we might get some choppiness, but I suspect again, even with last month's CPI, when the US session opened, that's when now we saw the direction coming. Okay. So what you need to take into account is there has to be that initial impact from the news or from the CPI reading. Now, immediately when that initial impact happens, okay, then it is followed by the actual move. So the actual move, we shall see that move happening towards the open of the US session. So between 4 p.m. close to almost 5 p.m., we are going to see how the market digests that CPI. So it's important that especially expecting that you're going to see an opposite CPI reading. What is important for traders now is to wait for the CPI news to first come out. Let the data first come. When the data comes out, then we can see how the market has absorbed it. Okay. I've seen moves on currency pairs where even after CPI comes out, the currency pairs will remain choppy by about in a range of almost 50 pips. They're just choppy. And then after 1-2 hours, we find the movement now coming, and you find a sell-off happening. Okay, so you don't have to wait. You don't have to take the CPI trade as it is. You could wait for after CPI. Okay, but as we go into CPI right now, definitely the bias is a dollar bullish. Okay, the market's expecting the dollar to react positively to today's CPI. That's why we're having a bullish dollar currently as we go along. So I hope that answers your question, Jimmy. Joseph, you're saying, hello, Norbert, how is Uganda? Uganda is awesome. Uganda is great. A very hot day today so far, but Uganda is doing great today. And I hope you're doing awesome wherever you are, and you're having a great time. Okay, so let's see the next question here. In case we have a higher CPI, do you expect stocks to rally? Now, tech stocks trade opposite to higher CPI. Last year, when we had very, very high headline CPI, we had the tech stocks getting a beating. The reason for that, or the explanation for that, is because whenever we have a higher inflation numbers, the consumers or the households like you and me will have to cut back on their investments, and they first usually cut back on the tech stocks. Okay, and when they do that, that money which they have gotten from their investment, so the Bitcoin, first leave your NSSF maybe and every other saving that you have, you're focusing on your investment. So you have like the stocks, okay, then you have like the maybe like the cryptos, all those different. You have investors cutting back on those ones, and then they now move that money to cater for the rising prices. So usually the future inflation expectations, higher future inflation expectations, is usually bearish for the stocks, most especially the tech stocks. Okay, so if we get a higher headline number today, then we are going to see of the indices, and even for the stocks, the ones that are going to take the biggest beating are usually the tech stocks. So Nasdaq usually will react more to CPI, than all the other different indices. Yeah. Victor, you're saying, should we expect GBP/JPY to go further upward? Yeah, so GBP/JPY again, like you'll have to just listen to the video again. I mentioned in for GBP/JPY, it's still within a choppy range, and we should see how it reacts within that area. But right now, GBP/JPY is forming what we call a bearish flag, and it is aiming to take out this level here, which is roughly around 44 pips from where it is trading right now. If it breaks below there, then it could initially take a break lower here, which could move it back to this supply area here, which is around 180 yen. So that's what I can say for GBP/JPY. I just need a guide on how to place a trade in Meta 4. So 10 lifters, just kindly check under our YouTube channel. We have a playlist. Playlist is called Novice to Pro, which was done by my colleague Rufus. So if you watch that playlist, you're going to be able to get to understand how you can set up trades in MetaTrader 4. However, I would advise you to use MetaTrader 5 because right now the support for MetaTrader 4 is currently not there. So most of the FX Pesa clients are now using MT4 and even the equity trader. Yeah. Chris G, how are you? You're saying if CPI favors the dollar to be strong, it means your USD to fall. What about Bitcoin? Does it affect it in any way? So Bitcoin again reacts to a higher CPI reading is usually Bitcoin bearish. So we are going to see Bitcoin possibly reacting negatively if we get a higher core reading as well as also a higher headline number for CPI. That is both on the fronts for the year over year as well as also for the fronts of a month over month. Let's look at AUD/USD kindly. Okay, and then Apple is saying weak Euro Asia economic data dovetailed with stronger US data. Me feels with strength in DXY, regardless of weaker inflation data, none of the Euro Asia central banks will hike rates as well as the Fed. Yeah, so again, Euro Asia, just like again you have mentioned, what's essentially been happening is you have been getting a lot of weak data coming out from Euro Asia, and again, most of the different analysts and again even the economists are pointing that China is currently undergoing what we call a contraction. Okay, and that again is having a spillover in New Zealand, in Australia. Same thing. Also, we are also seeing that spillover happening even for Europe. Okay, so now for China, they are currently doing rate cuts, and the reason why they're doing that is that they're trying to see how they can support their economy to potentially get back on its feet. Now, Europe is also pointing towards that direction for now, and the reason why they are doing that is they want to avoid an issue of stagflation. Right now, they have very sticky inflation, which is high, and also now their economy, the PMIs, same thing also for the GDP numbers, have been pointing towards contraction. So they also are looking to see if they can pause their rate hikes so that they can try to help to boost the economy. But however, that does not solve the inflation issue. So it's a very tricky situation for the central bankers, and we are going to see how time tells with that. So Lucy, you're quickly saying, okay, before I go to Lucy, as I wind up with Lucy, I'm going to just answer Apollo here. You're saying outside economic data, how do you anticipate spread for MT4, MT5 FX Pesa platforms? I normally get orders to fail to fill or sell out in a line with analysis on TradingView. Do zero spread account behave similar? Definitely not. Of course, zero spread account, as you've alluded to, those ones don't have zero spreads. Spreads, again, guys, just talk about spreads. Spreads usually are high on holidays, okay? When the markets are slim, with very slim liquidity, very slim volume, then spreads are normally high. The best time to anticipate very tight spreads are when there's a lot of momentum and movement in the market, usually when we are having after news. Around the time for news, especially when news has just hit, and high impact news like US CPI, spreads normally widen, okay? But after that, normally they come down to their average spreads. What I can say for this one is for FX Pesa, we have two accounts. We have the Premier, we also have the Executive. The Premier is the one which has the tight spreads, which are close to zero. And then the Executive has the slightly wider spreads. So it's up to you to decide which ones to go for. But for anticipating spread, Apollo, to answer your question, usually you look for avoid times when the market is having turbulence like news. That is when you can expect the spreads to actually widen. So try to see how you can cope with that. Okay, so AUDUSD, just to answer you, Lucy, AUDUSD right now, we have one bearish flag, okay, and there's actually right now there's another one which is currently in formation. I'm expecting AUDUSD to continue weakening to the downside. And the reason for that is because we have been having a lot of weak data coming out from China, but also a stronger DXY is not allowing the AUDUSD bulls to potentially reach certain levels. Currently, and even for today, the main level that we are going to be focusing on is this level here. Okay, this one right here. If we get a break below here, which again is possible today, then we should see AUDUSD selling all the way back to its level, which we saw sometime last year around 2022. So it's just a wait and see. We have to see how things develop with that. Yeah, so I think that's it from me. I wish you all an amazing trading day today. Please don't forget to have risk management. And again, please also make sure that you follow the instructions wherever you're going to be trading, and also focus on following your strategy and ensuring that you're trading well. So with that, I wish you all an amazing day, and I'll see you all next week.